that situation existed with most securities in the market, including companies such as Inevitable. But it was designed to be sure that people did not take the remarks that I made about those companies and just take that as an unqualified buy recommendation regardless of price. We have no intention of selling those two stocks. We wouldn't sell them if they were selling at prices considerably higher than they are now. But I didn't want particularly relatively unsophisticated people to see those names there and then think this guy is touting these as a wonderful buy. Generally speaking, I think if you're sure enough about a business being wonderful, it's more important to be certain about the business being a wonderful business than it is to be certain that the price is not 10% too high or 5% too high or something of the sort. And that's a philosophy that I came slowly to. I originally was incredibly price conscious. We used to have prayer meetings before we would raise our bid an 8 around the office, but that was a mistake. And in some cases a huge mistake. I mean, we've missed things because of that. And so what I said in the report was not a market prediction in any sense. We never try to predict the stock market. We do try to price securities. We try to price businesses is what we try to do. And we find it hard to find wonderful, good, average, substandard businesses that look to us like they're cheap now. But you don't always get a chance to buy things cheap. Charlie?
Well, I certainly agree with that. The one thing we can confidently guarantee is that real inflation-adjusted returns from investing in a standard collection of stocks will be lower in the long-term future than they've been in the last 15 years or so. This has been an unprecedented period, and there will be some regression toward the mean in average returns from investing in the stock market.